Hey everyone, welcome back to Corporate Decoder. Today we are going to dive into Pharma Inc.'s latest filing, and by the end of this video you might be wondering if they are selling medicine or magic beans. And before we get started, if you appreciate getting the straight truth from corporate reports, make sure you subscribe to our channel. Also, come join our Discord channel in the description below for more in-depth discussions on all things corporate. Scroll item 1.01 entry Clayton into a material definitive agreement scroll. Let's get right to the main point of this filing a material agreement regarding a stock offering. This means Pharma has made a deal to sell more of its stock, which can have big consequences for current investors. On May 16, 2025, Pharma finished selling shares and warrants to investors in what's called an offering. They sold common shares, which are just regular shares of stock, and something called pre-funded warrants, which are like coupons that let you buy shares later at a set price. They also sold Series A1 and A2 common warrants, more types of coupons to buy future stock. This is a lot of financial jargon. But the important thing is that Pharma is creating ways for more shares to be available in the market. The price for each common share, along with its warrants, was 60 cents. The price for each pre-funded warrant and its warrants was a tiny bit less, about 59.99 cents. Scroll each common CAF to W unless the company is notified ahead of time, as each chand per share scroll TXI cents. The Series A1 warrants expire in 5 years, while the Series A2 warrants expire in only 18 months. There's a catch though. You can't use these warrants to buy so many shares that you would own more than 4.99% of the company unless the company is notified ahead of time. The pre-funded warrants can be used right away and cost almost nothing to use, just a tiny fraction of a cent to buy a share, but like the other warrants, there's a limit to how many shares you can buy to avoid owning too much of the company without giving proper notice. Scroll is compensation to H.C. Wainwright, and Amsemco Pharma paid H.C. Wainwright as a fee for helping with the offering. The company paid about 7.5% of everything raised in the offering, plus some extra for management and expenses, a total of $120,000. The company also gave the placement agent warrants to buy up to 250,000 shares of common stock. The placement agent warrants let them buy stock later for 75 cents per share. To make this offering happen, Pharma made a deal called a purchase agreement, and it was all the promises and guarantees from both sides. Scroll pursuant to the terms of the purchase agreement, Pharma promised not to issue any new shares or make plans to issue new shares for 60 days. For 1 year, they can't do anything involving what's called a variable rate transaction, which is a complex way of issuing stock with rates that can change. Scroll Liter Cabot executive officers and directors have agreed. Scroll the company's leaders, the executives and directors promised not to sell or trade their shares for 60 days after the deal closed, ensuring the market isn't flooded with shares right after the offering. Scroll these securities, the placement agent warrants and casement agent warrants and casement agent warrant shares were offered. Scroll these shares and warrants were all offered under a registration statement that was approved by the Securities and Exchange Commission, meaning everything was checked and is legally in order. Scroll, the company received net proceeds of approximately $1.6 million. Scroll, after all the fees, Pharma got about $1.566 million from this offering. They plan to use this money for working capital and general business needs. Pharma put out press releases to announce first the pricing and then the closing of this offering, keeping the public informed about what's happening. Now let's talk about what this means. Pharma, by selling these shares and warrants, is raising money, but more shares in the market can lower the value of existing shares. It's like slicing a pizza into more pieces. Each piece is smaller. The warrants are a bet on the future. If Pharma does well, the stock price goes up and these warrants become valuable because you can buy stock at a lower price than what it's worth on the market. But if the company doesn't do well, the warrants might not be worth anything. Pharma plans to use the money for working capital and general corporate purposes. This could mean anything from research and development to paying bills, but as usual, it would have been beneficial to have more information of the allocation of capital. So what's my take on all of this? On one hand, raising $1.566 million can give Pharma the fuel they need to pursue their goals, develop new products, or expand their operations. On the other hand, all these new shares can dilute the value of existing shares, potentially hurting current investors. The restrictions on issuing new shares for 60 days and on certain types of transactions for a year could provide some stability. But the company's future depends on how well they use this new capital and whether they can deliver on their promises. If they can't, the shareholders will suffer. Pharma is operating in a very competitive industry. The company needs to innovate, manage its resources wisely, and execute its plans effectively. Otherwise, this cash infusion will only be a short-term fix and it's back to the drawing board. Alright, that's our breakdown of Pharma's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord channel in the description. Thanks for watching. See you next time.